My next guest has had some pretty outstanding calls in the past year. He predicted the market's V-shaped rebound and then predicted the Fed's taper this year when few thought it was likely. And now he says the Fed is still behind the curve. Here to explain and tell you where the risks are in this market is Michael Darda, the chief economist and strategist at MKM Partners. Michael, it's great to have you back. Welcome.
Thanks for having me, Kelly.
So let's talk about, can I just ask you to make sense of the fall in bond yields for us today, especially in a world that you've correctly described as being a demand-driven shock with the Fed behind the curve? How do you explain this decline?
Absolutely. It certainly looks bizarre on its face. But if we look at what's driving bond yields lower, it's really a drop in the real interest rate. And I think that at least over the last day or so, that could be due to some speculation that Fed Governor Brainerd may be elevated to replace Powell, and she's viewed as more dovish. So what's also happening with this drop in real rates is inflation expectations actually are moving up. And at the 5-year horizon, we're almost at 300 basis points, which, would equal an all-time high, at least back to the late 90s when we've had the TIPS market. So real rates, very low real rates, are the main reason that bond yields are so low. And that can mean one of two things. It can mean that U.S. economic fundamentals are very weak, or it can mean accommodative monetary policy. In this case, I think it means accommodative monetary policy and a Federal Reserve behind the curve that's showing up in rising inflation expectations, and it's also more consistent with the cyclical boom that we've seen with the unemployment rate collapsing to a succession of post-COVID lows.
Right. So one of the other things that's been catching my attention is the all-time high in 30-year TIPS in terms of the price, which is pushing that yield to historic lows. So in other words, are you saying that the market is paying more and more and more for inflation protection now on a 30-year basis?
Yeah, that's exactly what's happening, and that's being reflected in those inflation break-even spreads, and those are at fairly high levels, at least relative to the last business cycle. We didn't see anything like 300 basis points tip spreads at the 5-year horizon. And so the bond market, despite these low yields, is pricing in a overshoot of, an average 2% inflation path. And we've already been well above 2% inflation. So, the Federal Reserve is going to have to make a decision here in terms of how much they are going to allow price pressures to run.
One more question on this, and then I want to get your investment implications. But again, for those who see the headlines and go, okay, producer prices at the highest level in over a decade, the 10-year yield is barely above 1.4%. But like you're describing, other market-based measures of inflation expectations and the cost of future inflation coverage are rising significantly. So why isn't the 10-year bond yield moving higher, or do you expect it to at some point?
Yeah, I think eventually the Fed is going to have to right the ship here and track the neutral interest rates. If the economy is recovering rapidly, the neutral interest rate will tend to rise. If the Fed fails to follow suit, then you have sustained inflationary pressure, and we're already facing that. But, we have a perception that most of the inflationary pressure is temporary and due to supply chain bottlenecks and so forth. But if overall nominal demand continues to run as strong as it's been running, then we're likely to see these inflationary pressures remain elevated, and the Fed will eventually have to address that by reducing liquidity and raising its short-term interest rate target. At that juncture, then real rates will have to move up. And again, I'm not saying they have to be high, but probably not minus 100 basis points.
Right.
It doesn't make a lot of sense in an economy that's rapidly reapproaching full employment if we're not already there.
Final question, then. Let's talk about what it means for the market, which, this is also what you're very good at translating. Where do you think the stock market offers opportunity in this scenario that you're describing, and where do you think the biggest risks are?
Yeah, that's an important question. So, the market's done phenomenally well because, as you noted, rates are still very low. Despite rising inflation expectations, real rates are at a record low, so the overall discount rate levels are low, profits are high, liquidity's high. So that's, really been a strong tailwind for equity markets. In an environment where inflation rates are sustained at elevated levels and discount rates are going to be moving northward, it's really those high valuation stocks which would tend to be at risk. They've still done pretty well this year, but we haven't had a really meaningful rise in the 10-year Treasury yield this year either. During periods where the yield's moving up, we tend to see value stocks outperforming and the growthier, more expensive names underperforming. So if we end up in a situation where the economy is pretty powerful moving into next year and inflation is higher and the Fed's going to be forced to move more quickly, I would be concerned about those areas that are really, appearing to be frothy now, either driven by momentum or, standing at extremely high valuations.